Hey everybody, it's Daniel here from InfoVest. Hope you're all doing well. So I've been mentioning this many times before on this channel, and it's coming true. We're getting the first rate cut in the US. It's coming in September. And the Jackson Hole event that we had last week basically signaled, Powell came out, sounded dovish, and said that, hey, we basically won on inflation and it's now time to adjust our policy, and it looks like that they're now going to start cutting rates and they're going to get into the rate cutting cycle. Now there's a couple of things to note about this, and before I get into it and before I talk about it, I'm going to discuss a couple of key quotes that came out from Chair Powell in his speech. So first things first, let's look at the policy outlook. The policy outlook related quotes sounded something like this: "The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risk." Saying that, okay, we're ready to cut rates, and in terms of how aggressive they cut rates will all have to do how bad this recession gets, right? That's basically what he's saying, but he's not using the R word, the recession word. Implication. Moving forward. Inflation. So this is a quote on inflation. So it says here, inflation is now much closer to our objective, with prices having risen 2.5% over the past 12 months. After a pause earlier this year, progress toward our 2% objective has resumed, right? So they're basically much closer to their objective, although it may not feel like that, right? According to them. And of course, they're closer to their objective because they keep stripping the data and manipulating it and changing it, as we've seen with the BLS data that just came out, the revisions, and that's the preliminary revisions, right? We haven't got the final numbers on that. So it could be worse, could be better, we'll see, right? But basically signaling that inflation is less of their target now, and their target, which they discussed, is now has to do with the labor market. They have a dual mandate. They have to focus on bringing inflation down to their 2% target and also making sure the job market's fine. Now they're worried about the job market, and let's hear what Powell had to say about the labor market. Today, the labor market has cooled considerably from the formerly overheated state. All told, labor market conditions are now less tight than just before the pandemic in 2019, a year when inflation ran below 2%. We will do everything we can to support strong labor market as we make further progress towards price stability. Okay, and we saw the signs, we saw the signals before, where Powell came out and kept discussing the focus on labor market, the focus on labor market, the focus on labor market. We've also heard from other Fed members as well talk about the labor market, the labor market, the labor market. The shift is going towards the labor market. Why? Like I told you, the recession's coming. And when that happens, we often see the unemployment rate skyrocket. On the balance of risk between inflation and jobs market, the upside risk to inflation has diminished and the downside risk to employment have increased. As highlighted in our last FOMC statement, we are attentive to risks to both sides of our dual mandate. Fed on the disinflation success. The 4.5 percentage point decline in inflation from its peak 2 years ago has occurred in context of low unemployment, a welcome and historical unusual result. Future considerations. Our statement on longer run goals and monetary policy strategy emphasizes our commitment to reviewing our principles and making appropriate adjustments through a thorough public review every 5 years. And then in addition, the Fed officials commented on Thursday and Friday ahead of Chair's remarks on a couple of things. Harker expressed a preference for gradual and methodical approach to cutting rates, noting that businesses are more concerned with a predictable and steady path toward neutral rates than the exact size of the rate cuts. Monetary policy is well positioned and not overly restrictive. And also, Harker said that the end of the easing cycle might leave the Fed funds rate around 3%, saying that they're going to cut and then it's not going to go to zero, but it's going to come to, that 3 or maybe 4% or whatever. But she said 3%, right? That could change anytime. Bostic basically said carefully monitoring upcoming labor market data before making definite decisions. So again, they're worried about the labor market. So what does all this mean? Everything that I explained. There's a couple of takeaways here. Number one, they're starting the rate cut cycle. Okay. If there's no recession, then yes, they're going to keep rates at 3-4% around there, if that's the case. Most likely this is going to lead into recession if you look at just plain history. Okay, just history. When you look at the past recessions, when you look at past easing and tightening cycles, it's just a trend. It's just the market always follows this trends of these up cycles and these down cycles, and we're about to see that. Last time we saw something similar, especially relating to the housing market. This time it's more related to the commercial real estate market, which can still flow into the housing market too, and the economy and so on. And it's much bigger than the commercial market is much bigger than the real estate, the housing, residential real estate market. Last time we saw that in 2007, September 2007, we saw a rate cut, the first rate cut, ahead of the big crash. A year later, right, 2008, September 2008, we had that final blow. But from September 2007 and onwards, we saw the markets head into a downward spiral. Now, it's not an easy crash. It has a lot of squeezes. It has a lot of moves up. It has people buying the dip always over and over and over again. So you will see the market squeeze up, then come down, squeeze up, then make a new low, squeeze up, then make a new low. And those squeezes, those moves up, those rallies can be quite aggressive. They can be 10 to 20% rallies from that low point. So could we see something similar? September 2024, we get the first rate cut. That could be, that could lead the equity markets to basically have a blow off top where it rallies first. We also did see that in 2007 when we got that rate cut, and then we had that final move up, and then that was the top after that, right? Then we just moved down. So we could see, that rate cut bringing optimism, the equity markets make a new high, and then it tops, and then we just move into 2025 of just a downward momentum move. But the aggressiveness of the downward momentum move and how ugly it gets is all dependent how aggressive those rate cuts come in. I know that sounds funny. You would think rate cuts would, especially big rate cuts like 50 basis points, 75 basis points, so on, would basically prop the market higher. But it's not exactly like that if you look at history. And that's where a lot of people don't understand it, because if you don't look at the economic history and you look at the past, you'll just listen to anyone that says rate cuts are good and now is the time to buy, and then you could be in a worse off scenario. I'm not saying rate cuts are bad. They definitely have a place there, and easing has a place there. But I'm just saying, in this short time frame, when you look at cycles, generally we see how this all leads to. And when you get that first rate cut in September, we could have another pump, and then afterwards when we get more rate cuts, and if we get aggressive like 50, 75 and so on, it's because something's breaking. As simple as that. The job market is getting worse off. I mean, we just had the BLS in its preliminary revisions take off 800,000 jobs, right? Think of what that number is going to look like, in 2025 when they come up with the final number. It could be worse. It could be that completely, there's additional more jobs than 800,000 that, that they took off. That should have also been revised to the data. So we're seeing that trend. We're seeing the upward trend in the unemployment rate. We're seeing it in the markets. We're seeing it in the bond market. We've yet to see it in the equity market, but I think 2025 we could see that. And here's your signal, this right here. Jerome Powell talking about this, the Fed members talking about this, the Jackson Hole event, right? Talking about the rate cuts starting, and then we're going to get the press conference in September and our first rate cut, the U.S. first rate cut in September, and that's it. That's the beginning. That's the beginning of things are going to start to slow down. Although that's counterintuitive, people think that things are going to speed up. History suggests something else. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified next video, and I'll see you guys around. Cheers. Bye.